Listen carefully. Silver just hit $71.94 per ounce on December 25th, 2025, up a staggering 149% year to date, and we're entering what traders call Ghost Week, the most dangerous trading period of the year. Starting tomorrow, markets will operate with barely 20% of normal volume as institutional desks close for the holidays. This liquidity vacuum creates the perfect conditions for explosive price gaps, and here's why silver could gap up $8 or more when markets reopen in January. Right now, silver is trading in price discovery territory after breaking through its 13-year resistance at $54. Citigroup, Bank of America, and UBS are all forecasting silver to hit $60 to $70 in 2026, with some bullish analysts predicting 88 or even 100. The fundamentals are rock solid. We are facing the fifth consecutive year of supply deficit, 95 million ounces according to the Silver Institute, while industrial demand from solar, EVs, and data centers continues surging. During Ghost Week, algorithms dominate trading with minimal human oversight. Any positive headline about Fed rate cuts, geopolitical tensions, or industrial demand could trigger a rapid mechanical buy program with no liquidity to absorb it. We've already seen $7.1 trillion in options expire during December's triple witching, and now thin holiday trading could magnify any momentum. The gold to silver ratio is still elevated, suggesting silver remains undervalued relative to gold. When institutions return in January with fresh capital and rebalanced portfolios, silver could gap significantly higher. Disclaimer: this video is educational content and market analysis, not financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. If you're watching this and find this analysis valuable, smash that like button right now. It helps more intelligent investors like you discover this critical market intelligence. Now, let me walk you through exactly why the next 7 days could define your entire position in silver for 2020. Because what is happening right now in the physical silver market is something we haven't witnessed in over a decade, and most retail investors have absolutely no idea what's coming. Let's start with the elephant in the room: Chinese inventories. Right now, as I'm recording this, warehouse inventories at the Shanghai Futures Exchange have collapsed to just 531,200 kilograms, which represents the lowest level we've seen since 2015. Think about that for a moment. We're talking about a 10-year low in one of the world's largest physical silver hubs, and this didn't happen by accident. In October alone, China exported over 660 tons of silver to London, and that's the highest monthly export volume on record. They literally put silver on airplanes and flew it across the world because the demand was so intense and the premiums were so high that it made economic sense to pay for air freight on one of the heaviest commodities you can transport. But here's what makes this situation truly dangerous for anyone not positioned in silver right now. The Shanghai market has moved into backwardation. For those who might not be familiar with this term, backwardation is when near-term futures contracts are trading at a premium to longer-dated contracts. And it's one of the most bullish technical signals you can see in any commodity market. What this tells us is that there's such acute physical tightness in China that buyers are willing to pay more for immediate delivery than they are for delivery 6 months from now. This isn't speculation. This isn't sentiment. This is industrial users and fabricators literally panicking about their ability to secure physical metal for production. Now let me connect this to what's happening in the broader supply picture, because the Chinese inventory crisis is just one piece of a much larger puzzle. According to Metal Focus, we're looking at the fifth consecutive year of structural supply deficit in 2025, with the shortfall projected at 63.4 million ounces. And while that number is expected to moderate slightly to 30.5 million ounces in 2026, the keyword here is deficit. We're still talking about demand exceeding supply for the sixth straight year. This isn't a temporary imbalance that's going to correct itself with a small price adjustment. This is a structural problem rooted in the fact that approximately 75% of silver is mined as a byproduct of other metals like copper, zinc, and lead. What this means in practical terms is that silver supply is incredibly inelastic. Even with silver prices doubling this year, we're not going to see a flood of new supply hitting the market because you can't just open a new silver mine overnight. The mining companies that produce silver as a byproduct aren't going to dramatically increase their copper or zinc production just because silver prices are high. Mine development takes years, or grades have been declining across major producing regions in Central and South America, and there's been chronic underinvestment in exploration and development for over a decade. The Silver Institute is projecting that the cumulative deficit from 2021 to 2025 will exceed 820 million ounces, and that number keeps growing every single year. Now, let's talk about the demand side of this equation, because this is where things get really interesting. Industrial demand for silver isn't just holding steady, it's accelerating. The Silver Institute recently published a report titled Silver, the Next Generation Metal. And what they're forecasting is that heavy demand through 2030 is coming primarily from the clean tech sector. We're talking about solar panels, electric vehicles, and emerging technologies like artificial intelligence, data centers, and 5G infrastructure. Silver's unique properties, the highest electrical and thermal conductivity of any metal, make it absolutely irreplaceable in these applications. Let me give you some specific numbers to put this in perspective. Global photovoltaic installations are projected to surpass 500 gigawatts annually, and silver loading in solar cells averages between 80 and 100 milligrams per cell. This means demand from the solar sector alone could exceed 230 million ounces by 2026. Electric vehicles are using between 25 and 50 grams of silver per unit, and global EV production is scaling exponentially year over year. The United States government recognized silver's strategic importance by adding it to the critical minerals list in 2024, which is a designation that enables potential tariff applications and acknowledges that silver is essential to national security and economic prosperity. But here's where the Ghost Week dynamic becomes absolutely critical to understand. Right now, institutional trading desks are shutting down for the holidays. The big banks, the hedge funds, the algorithmic trading firms, they're all running skeleton crews with minimal human oversight. Market liquidity during this period typically drops to around 20% of normal levels, and what that means is that price discovery becomes incredibly inefficient. In normal market conditions, if a large buy or sell order comes into the market, there are enough participants on the other side to absorb that flow and prevent massive price dislocations. But during Ghost Week, that absorption capacity essentially disappears. Think about it this way. Imagine you're trying to sell a house in a neighborhood where 99 out of every 100 potential buyers have left town for the holidays. The one buyer who's still there has enormous leverage because there's no competition. The same principle applies to silver during Ghost Week, except in reverse. If positive news hits the market, let's say the Federal Reserve signals more aggressive rate cuts, or there's a geopolitical flare-up, or a major industrial buyer announces a massive long-term purchase contract, the algorithms that are still running will start executing buy programs, and there won't be enough sellers in the market to provide liquidity at reasonable prices. The result is a gap up, potentially a massive one. And we have recent precedent for exactly this kind of price action. Look at what happened in early December when the Federal Reserve delivered its third consecutive rate cut, bringing the federal funds rate down to the 3.5 to 3.75% range. Silver hit a record high of 61 toward 87 per ounce immediately following that announcement. The Fed's dovish stance, maintaining an outlook for one additional cut in 2026, created a tailwind for precious metals because lower real rates reduce the opportunity cost of holding non-yielding assets like silver. When you can get 5% in a money market fund, there's a legitimate argument for keeping some capital in cash. But when rates are coming down and real yields are declining, suddenly the relative attractiveness of hard assets increases dramatically. Now, let's layer on top of this the investment demand picture, because what we're seeing in ETF flows is truly unprecedented. Philip Newman, the managing director at Metals Focus, noted that inflows into silver exchange-traded funds have increased by 187 million ounces in 2025. He specifically cited investor concerns over stagflation, the Federal Reserve's independence, government debt sustainability, the US dollar's role as a safe haven, and geopolitical risks as the primary drivers. What this tells us is that silver is not just benefiting from industrial demand, it's also serving as a monetary asset, a store of value that investors are flocking to as a hedge against currency debasement and political uncertainty. The gold to silver ratio is another critical factor that intelligent investors need to understand. Currently, this ratio is sitting around 70 to 72, which means it takes 70 to 72 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged between 60 and 80, but there have been periods where it's compressed significantly. During major bull markets in precious metals, silver tends to outperform gold on a percentage basis because of its dual nature as both an industrial commodity and a monetary metal. The leverage works in both directions. Silver falls harder than gold in bear markets, but it rises faster in bull markets. Major investment banks are taking notice of this dynamic. JP Morgan is forecasting that gold could reach $4,600 by mid-2026. And if the gold to silver ratio compresses even modestly from current levels, that implies significantly higher silver prices. Some analysts, including RBC and UBS, are projecting silver to rebound to a range of $55 to $75 per ounce by mid-2026, citing both industrial resilience and speculative momentum. Bank of America is forecasting $65 per ounce, while more aggressive bulls like BNP Paribas are suggesting silver could climb as high as $100 per ounce by the end of 2026, as investors seek safe haven assets amid persistent inflation and geopolitical risks. Now, I want to address something that's critically important for anyone watching this video. the concept of price discovery territory. When silver broke through $54 per ounce, it shattered a 13-year resistance level that had capped prices since the 2011 peak. What happens after a major breakout like this is that there are no historical reference points above that level to guide market participants. Traders and algorithms that use technical analysis don't have clear resistance levels to target, which means the upside becomes much more open-ended. We've already seen silver push above $70, and while there's been some consolidation and profit-taking, the underlying physical market remains incredibly tight. Let me tell you what's happening on the ground at precious metals dealers right now, because this is where theory meets reality. Physical premiums for silver products, American Eagles, Canadian Maples, generic rounds, are at or near record levels. Dealers are paying higher than normal premiums over spot price to acquire inventory because their customers are buying aggressively and restocking is becoming more difficult. This isn't sentiment, this is actual supply and demand playing out in real time. When you see physical premiums expanding while futures prices are consolidating or pulling back slightly, that's a classic signal that the paper market is disconnected from the physical market, and eventually that disconnect gets resolved through higher prices. The macroeconomic backdrop heading into 2026 is also highly supportive for silver. The Federal Reserve has executed 3 rate cuts in late 2025. And while they've signaled a more cautious approach to further easing, the dot plot still shows expectations for additional cuts through 2026 and 2027. Chairman Powell has been relatively dovish in his communications, and with President Trump expected to nominate a new Fed chair in May 2026, there's widespread speculation that the next chair could be even more accommodative. Trump has consistently advocated for lower interest rates and easier monetary policy, and if the new Fed leadership takes a more aggressive easing stance, that would be rocket fuel for precious metals. At the same time, we're seeing structural changes in central bank behavior that have profound implications for silver and gold. Central banks around the world have been accelerating their gold purchases as a way to diversify foreign exchange reserves away from the US dollar, especially in the wake of geopolitical tensions and concerns about US fiscal sustainability. While central banks primarily buy gold rather than silver, this demand creates a spillover effect. As gold prices rise and the gold to silver ratio remains elevated, investors looking for leverage and value increasingly turn to silver as the more affordable precious metal with similar monetary properties. There's also a geopolitical dimension to this story that's worth understanding. The United States has intensified its economic pressure on countries like Venezuela through oil blockades, and we're seeing escalating tensions between Russia and Ukraine, between Israel and various actors in the Middle East, and between the United States and China over trade policy and technology dominance. Every time geopolitical uncertainty spikes, investors instinctively move capital into safe haven assets, and silver benefits from this flight to quality alongside gold. Now, let's talk about the specific mechanics of how a gap up could occur in January. Imagine this scenario. It's January 2nd or 3rd, the first full trading day after the New Year holiday. Institutional desks are coming back online, portfolio managers are reviewing their allocations for the new year, and suddenly there's a confluence of positive factors. Maybe the Fed signals another rate cut is coming sooner than expected. Maybe China announces a massive stimulus package that includes aggressive support for solar energy and electric vehicle manufacturing. Maybe there's a supply disruption at a major mine in Latin America. Any one of these catalysts could trigger a wave of buying, and with fresh capital being deployed at the start of the year, the momentum could be self-reinforcing. What happens in this scenario is that algorithms detect the buying pressure and start executing their own buy programs based on trend following and momentum strategies. Systematic funds that allocate to commodities based on price action begin increasing their silver positions. Retail investors see the price moving and don't want to miss out, so they start piling in through ETFs and futures contracts. Before you know it, silver is gapped up $5 or $8, maybe even $10 from where it closed before the holiday. And anyone who wasn't positioned beforehand is stuck chasing the price higher or accepting that they missed the move. I want to be very clear about something, though, because it's important to maintain intellectual honesty when analyzing markets. While the fundamental case for higher silver prices is extremely strong, and while the setup for a gap up in January is very real, there are also risks that could derail this thesis. If the Federal Reserve turns more hawkish than expected and signals that they are done cutting rates or might even consider hiking rates again to combat sticky inflation, that would be negative for precious metals. If industrial demand weakens due to a global economic slowdown or a recession in major manufacturing economies like China, Germany, or the United States, that would reduce one of silver's key demand drivers. If mine supply responds more quickly than expected, perhaps through increased recycling or the restart of previously shuttered mines, that could ease the tightness in the physical market. There's also the possibility that we're currently in a speculative bubble and that silver prices have run too far too fast based on momentum and enthusiasm rather than fundamentals. The 149% year-to-date gain is extraordinary by any measure, and there's always a risk of a sharp correction when an asset has moved that aggressively in such a short period of time. Some analysts have pointed out that silver is now approaching its inflation-adjusted all-time highs from 1980, and that previous peaks were followed by devastating multi-year bear markets. The CME, the Chicago Mercantile Exchange, has a history of raising margin requirements during periods of excessive speculation, and such a move could force leveraged traders to liquidate positions, triggering a cascade of selling. But here's what I keep coming back to when I evaluate these risks against the bullish case. The fundamental supply-demand imbalance is real, it's measurable, and it's getting worse, not better. The deficit isn't narrowing, the inventories aren't rebuilding, and the industrial demand isn't slowing down. Yes, prices have risen dramatically, but they've risen because the market is finally recognizing the severity of the structural shortage. When I look at the analyst forecasts from major investment banks, institutions that employ teams of commodity strategists with access to proprietary data and sophisticated modeling, there's a remarkable consensus that silver prices are heading higher in 2026. Citigroup expects silver to trade between 40 and 43 over the next 6 to 12 months in their most conservative scenario, but they acknowledge that persistent deficits and surging demand for solar applications could push prices much higher. WisdomTree's projections reach $56 by 2026, building on the thesis that investment inflows will accelerate as inflation expectations reemerge and monetary tightening cycles reverse. Both firms view silver's dual nature, industrial and monetary, as its defining strength relative to gold. Even HSBC, which maintains a relatively conservative outlook with forecasts ranging from 38 Palmetto 56 in 2025 to 44.50 by 2026, is still projecting higher prices from current levels, just at a more modest pace. What's interesting is that the more aggressive forecasts are not coming from permabulls or fringe analysts, they're coming from serious institutions. BNP Paribas suggesting $100 per ounce by the end of 2026 is a massive call, and it's based on their assessment of safe haven demand, persistent inflation, and geopolitical risks. Larry Leopard, a well-respected investor in the precious metals space, sees potential for $75 by mid-2026. Keith Neumeyer, the CEO of First Majestic Silver, one of the world's largest primary silver producers, has publicly stated that he considers $100 silver not only possible, but likely given the fundamental setup. So where does all of this leave us as we head into Ghost Week and then into January 2026? From my perspective, the risk-reward for being positioned in silver right now is extremely favorable. Yes, there could be short-term volatility. Yes, there could be a pullback or consolidation before the next leg higher. But the structural forces driving this market, the multi-year supply deficit, the explosion in industrial demand from clean energy and technology, the monetary debasement concerns the geopolitical uncertainty, the central bank gold buying, creating spillover demand for silver. These are not temporary factors that are going to disappear in the next few months. If you're an intelligent investor who does your own research and thinks critically about market dynamics, this is the kind of setup that you should be paying very close attention to. Ghost Week represents a period of maximum danger and maximum opportunity. Danger because price action can be erratic and unpredictable when liquidity dries up. Opportunity because a properly timed position ahead of a gap up can generate outsized returns with relatively limited downside if you're wrong. Now, I want to emphasize again, nothing I'm saying here should be construed as financial advice. This is educational content designed to help you understand the forces at play in the silver market so that you can make your own informed decisions. Every individual has different financial circumstances, different risk tolerance, different investment objectives, and different time horizons. What makes sense for one person might not make sense for another. I strongly encourage you to do your own due diligence, to consult with a qualified financial advisor who understands your specific situation, and to never invest more capital than you can afford to lose. But if you're someone who's been following the silver market, who understands the fundamental case, and who's been waiting for the right entry point or the right catalyst, I would argue that we're in one of those rare moments where everything is aligning. The physical market is as tight as it's been in a decade. The macroeconomic environment is shifting in favor of hard assets. The technical setup shows a major breakout with no clear resistance overhead. The seasonal pattern of institutions rebalancing portfolios and deploying fresh capital at the start of the year creates natural buying pressure. And Ghost Week creates the perfect conditions for a price dislocation that could leave latecomers scrambling to catch up. This is why I wanted to make this video and share this analysis with you today. The next 7 days could define how silver trades for the entire first half of 2026. And I believe that informed investors who understand what's happening behind the scenes have a significant advantage over those who are simply reacting to headlines and price movements. The silver market is sending us signals. Chinese inventories at decade lows, backwardation in Shanghai, record ETF inflows, major investment banks raising price targets, industrial users panicking about supply, and these signals are telling us that something big is building. Whether that manifests as an 8 gap up in January or a more gradual grind higher over the course of several months, I can't predict with certainty. But what I can tell you is that the setup is there, the fundamentals are there, and the catalysts are there. The only question is whether you're going to be positioned to benefit when it happens, or whether you're going to be watching from the sidelines wishing you had acted when you had the chance. So that's my analysis of where we stand right now with silver heading into Ghost Week and the start of 2026. I hope this deep dive into the data, the market mechanics, and the fundamental drivers has been valuable for your understanding of this market. If you found this content useful, if it helped you see something you weren't seeing before, or if it confirmed your own research and gave you additional confidence in your thesis, then please hit that like button. It really does help this video reach more people who could benefit from this information, and it tells the algorithm that this is content worth promoting to other intelligent investors who are trying to navigate these markets successfully. Thank you for watching, thank you for your time and attention, and I'll see you in the next video where we'll continue tracking this silver story as it develops through the holidays and into the new year. Stay safe, stay informed, and remember, education and preparation are your best defenses in volatile markets.